Hello and welcome back to our weekly market recap. I'm with Rich
Hello, everyone.
and I'm Knight. Now, before we get to it, if you guys could slap a like on this video, subscribe to our YouTube channel. If you have any questions, comments, put it down below in the comment section. We love interacting with you guys, answering questions. And the more engagement we have, the more eyes that this goes to, people get to see it and interact with us. So beneficial, people get to learn about what's going on in the market. Now, let's get to it. So this past week, we saw the market fall 1.38%. We're still up year to date, 11.12%, but this was the worst week that we've seen in the market since back in February. It was a pretty big sell-off. And the biggest question floating around the market isn't whether or not we have inflation, because the reality is we have inflation right now. The CPI data that we had from April shows currently we are experiencing inflation. But the question is inflation here to stay, or is it just transitory and we're going to start seeing a disinflation or not at the same rate?
And let's remember, some inflation is good. It's not just a black and white inflation is bad, but too much inflation is bad.
Absolutely. And so we had the CPI numbers come out on Tuesday, which showed one thing, and then retail numbers came out on Friday. And so we're going to go into both of those, and then we're going to end with Rich's thoughts on some of the retirement articles that he's seen coming out of COVID. So if we jump into what we saw this week in the market, so what we see is we start off the week relatively good all the way through Monday, and then Tuesday morning, CPI data comes out, massive sell-off, inflation comes in higher than expected. People are really, really afraid that inflation is going to run rampant. It's here to stay. It's going to keep going. And we see this panic and fear in the market that leads to this massive sell-off. Then around Wednesday, Thursday, near the end, we start to see a little bit of a recovery, still sell off back into Thursday. And then Friday, we had retail numbers come in, and they were actually worse than expected. And that actually led the market to start to recover pretty dramatically, to recover about half of the losses that we had already experienced. The headline number that we saw on Tuesday was pretty scary. It's the highest number that we've seen since 2008, and it proves that inflation is currently here. We are experiencing it. But as we actually dig deep into the data, it leads to question, is inflation really here to stay? So if I pull up the actual data, and so this is the data from the Bureau of Labor Statistics, we start with an increase month over month of 0.8%. Now that's absolutely higher than what was expected. And if we annualize that, which it's unrealistic to annualize it, but if we did, that's 9.6%. If we had inflation at 9.6%, just like we're back in the 80s, and there was a lot of pain when it comes to massive inflation like that. Now, if we look at the 12 months, it came in at 4.2%. Again, higher than what was expected. We were expecting around 2.8%, around that. So to come in at 4.2, massively overshot what was expected. But this is where we get through that headline number, the first paragraph, really scary. We read the second paragraph, and the story already starts to change slightly. If we look at the first couple sentences, it says the index for used cars and trucks rose 10% in April. This was the largest one-month increase since the series began in 1953, and it accounted for over a third of the seasonally adjusted all items increase. So what does that mean? That means out of the 4.2%, 1.4% was just because of used cars and trucks. Now, if we take that out, now we're back at that 2.8%, which is right around what was expected. So we had this one category that drastically rose the whole number. And if we think about this one category, why is it so high? Really, it comes down to the chip shortage. So, Rich, what are your comments on the chip shortage?
Well, we have two issues that are going on. One is, if you remember, during the lockdown, warehouses were shut down. As a result, we couldn't get shipments in. Many of our chips come from overseas, and we've yet to have catch up on the demand for chips. And we see this not just in the United States, but throughout the globe. In addition, not looking at chips, but looking at something similar, we see this with lumber, plastics for housing, etc. There were certain little bottlenecks that are going on, and most of these will be temporary. And when it comes to massive inflation movements, if it's a transient number, as Nida said, it's not that scary. If it's something that's going to be systemic and chronic, that is hugely different.
So this is mostly just for the data nerds out there, but if you actually go deeper into the report, you get to start seeing what is in this basket of goods that's in the CPI. And it's honestly pretty interesting. So you see food, meats, poultries, and it's not like everything just goes in one direction. So we saw that inflation, the all items, the CPI was up 4.2. But if we look underneath all the basket of goods, it's not like everything just goes up. So food was up 2.4, but we see breakfast cereal down in these pieces, but meats went up significantly. Not surprising considering in Texas with some of the processing centers having to close. So meat going up, that seems realistic. But eggs, look how far eggs went down. So this is just interesting. When we went through, obviously, if we scroll down to used cars, we saw that 10% number. And that's definitely one of the pieces that pulled up everything. But another interesting area that I saw that I wanted to bring to everyone's attention was in the travel sector. Truck and car rentals up significantly. The unadjusted to the adjusted up 14.4%. We see airline fees. So it's not just the used cars, used trucks that pulled everything up, but there are these different sections that we expect based out of COVID. Of course, there's more price appreciation when it comes to travel because there's all this demand in travel. So the headline number that we see, absolutely scary. Some of the worst data that we've seen actually since the 80s. And what happens when you're comparing inflation to the 80s? Scare in the market. So that happened. But as we were digging in, it didn't necessarily seem as scary or as here to stay as we potentially initially were expecting.
When you look at it, it looks much more transient and much less systemic. We have some bottlenecks due to certain issues. And as I've said before, and it looks as if this is going to play itself out.
Yeah, and one piece that actually came to support that, retail numbers came out on Friday, and the market was expecting a 1% increase in retail sales for the month of April. It actually stayed flat at 0%. And we're now just in a market where bad news is all of a sudden good news for the market, which in most situations would be bad news for the economy. But in a place where we're worried about the economy overheating and inflation running rampant, actually seeing retail sales missing pretty significantly is beneficial. And what that means is once people stop getting the stimulus checks or the other pieces from the government, that extra money wasn't going to retail. It wasn't going to the consumer discretionary people spending.
Basically, when people were getting extra money from the government, they were spending. And as those stimulus checks ceased, people stopped spending. And it shows that demand is very reactive to the amount of cash that consumers have. And for long-term analysis on inflation, that's an important factor. And that means that we're not going to get an overheating of the economy.
When economists are worried about the economy overheating, having worse than expected numbers actually is beneficial. If we hit that 1%, we keep fearing, okay, people are buying everything. We're going to keep seeing prices go up. With price go up, more inflation and snowball. So actually getting some cool water splashed across our face when it comes to that is beneficial. Now, there are a lot of smart people who are saying that inflation is here to stay for the long run. And I do just want to put a comment as to where we could see it continue. we still have not seen supply chains really open up to the same level of demand that we have been seeing. So there is a shortage there that could persist. And I wouldn't be surprised if that does persist again through the summer, maybe even into September. But I expect us to get that supply chain relatively normal in fall. But what if all of a sudden winter comes around, holiday season, demand spikes again? I could see another shortage, or if our supply chains weren't fully put, then another spike in prices. Now, I still think that it doesn't matter as much what happens this year with prices as really what happens next year, 2 years from now, 3 years from now. And I do think over the long run, it's very hard to get consistent inflation at 2%. But I do want to say that it's not like this is a definite, this is transitory, we see it, and we're not going to have inflation in the future. We could, and there is a path to that. But right now, it doesn't look like it's the most likely path. Now, Rich, you were saying that you've seen a lot of articles around retirement, fear around not having enough to retire, and it's kind of been frustrating you a little bit.
Yes, there have been many articles actually over my entire career. So we're talking about 40 years now about people not saving enough, about Social Security running out, pensions not enough, that people don't know how to invest, they don't put away enough for retirement. And one of the things that I thought was quite interesting is that during the pandemic, there were several surveys being done of retired people and working people. And what they discovered is that 80% of retirees felt that they had enough money to go through and were not concerned about their retirement looking forward, despite the pandemic and despite all the issues with the economy. I think that is a very good harbinger of things to come.
Yeah, Rich, one thing that you said that landed so strongly with me was in some ways people end up just living their lifestyle in what they can afford. Your whole career, people have been saying the general public doesn't have enough money to survive on retirement. But when people actually end up retiring, they kind of start to fit their lifestyle to what they can afford. And thus, a lot more people can actually survive in retirement than all the numbers, all the statistics say. And that's not something that's really talked about enough. Now, maybe they're not spending the same amount as they were when they were working. Maybe they've cut or reduced some expenses, but they also aren't in poverty, which is what all the data says is that it's something wild. Rich, what's the number that the amount of people that shouldn't be able to support themselves in retirement?
Yes, I think it's something like 80 or 90% of the public gets most of their income from Social Security, and that means that they're at risk of becoming impoverished. And what we have really seen, as Knight brought up, is that as long as somebody has shelter and enough money for food and they can afford health care, that's probably gives them most of their well-being. And we haven't seen a huge depression amongst the elderly, despite quite a few interesting years that we've had the last several.
Yeah, and the pandemic hasn't shifted that as much as some would even expect. So, anyways, we appreciate you all for tuning in. As always, we're here to support you. Your money's here to support you, and we'll see you again next week.